Hi there folks, it's James Marley here, co-founder at Livewire Markets, and welcome to this special one-on-one interview with Marcus Padley. Now at the start of the year, we asked Livewire readers which investors they wanted to hear more from in 2025, and the top named Australian investor was Marcus Padley, just in fourth position behind Warren Buffett, Donald Trump and Elon Musk. So some good company there for you, Marcus.
Thanks, James.
Thanks for coming to Sydney. Great to have you in the chair.
My pleasure. Great. Glad to be here.
Now, I know a lot of our audience and our viewers do know who you are. Not everyone might be familiar with your background. So why don't we start there? 40 years of stockbroking experience. What are some of the things that have stuck with you during that time that you hold on to? And what are some of the things that bounced around markets that you picked up that you've chosen to pass to one side?
Right. So when I went to work for one of the big investment banks, which you know the name of, but I won't name. And this was 30 years ago. They sent me on a 1-week residential sales course. And they taught us how to sell financial products. And I can tell you how to sell financial products. It's very easy. They taught us the line that what you have to do is raise the expectation that if you buy this product, it'll improve your standard of living. It's a very specific description.
Usually a boat on the background or something like a nice big yacht.
Rene Rivkin was brilliant at that, wasn't he? Buy my newsletter and you too can have a yacht on Sydney Harbour. So that works, but it was you had to raise the expectation of an improvement in your standard of living by buying a financial product. The amazing part of it was they explained that if you actually improve someone's standard of living, then it defeats the product. You're going to have to sell them something else. It has to be a constant expectation. So the game wasn't actually to improve someone's standard of living. It was to sell the financial product using that trick. And that, over a period of a week, although I look back and go, wow, that was a brilliant course because it taught you how to sell. At no point in that week did they say that you have to look after the customer and the customer has to make money. And if I've learned anything about the industry over, I started in 1982, so what's that, 43 years, 20 of that was institutional broking. If I've learned anything over that period is that the industry's success is not necessarily the customer's success, if you follow that.
Yep.
We'll probably get to a bit of that. But that was an abiding thing. The other thing that got me as well was we had lunch with an institutional analyst who'd moved from the gold industry in the industry. So he was very empirical about how much gold they find and how much success they have. And he'd moved into funds management. And we were taking him for Christmas lunch and he said, you better just hold on the champagne because I've got my salary review this Christmas time. Salary review just before I come to lunch. And John, hello John, if you happen to be there still. And John said, I have lost so many millions this year because the gold price had gone down. And I'll be lucky to have a job, so hold on the champagne. And I was working for a big broker. I mean, it was, you don't order the second best bottle of wine, you order the best bottle of wine. And John turned up and he said, open the champagne. He goes, I may have lost everybody millions, but apparently I outperformed. They've given me a salary rise and a bonus. And you began to realize, okay, so that's the construct of the finance industry, is it's judging itself on relative performance. And I think it actually believes that relative performance is the benchmark. But the truth of the matter is all the Marcus Today members, for instance, are sitting at home looking after their own super. We've got 70% of our demographics over 60. Tells you we've got a lot of people, retired, self-directed investors. They have absolutely zero interest in a relative performance. It's not good enough for me to say, oh, the market fell 54% in the GFC, but you only fell 50%. So we did well.
Yep.
It's just not enough. And this comes to timing the market. You simply have to recognize that the customer is the one that counts. And in my world, a lot of retail investors, it's about absolute dollars, absolute returns, not relative returns. So if I was to say anything about the broking industry, not the broking industry, about the finance industry, and they can't help it. I mean, when you've got billions, you can't be timing the market and stuff. Can't help it. But the customer's success is not the industry's success. And I think clients or customers or self-directed investors just have to be aware of that and see everything from that perspective rather than from what they're being told constantly.
Yep. Now, I was on your YouTube channel when I was doing a bit of background viewing and research ahead of our chat, and there was a video titled Myths and the Matrix, where you question a lot of popular sayings that we hear repeatedly around the industry. I was hoping you could maybe just summarise the core premise that sits behind this matrix concept.
Right, so the Matrix film is the reference, and if you look at the Matrix film, everyone's living in a world, but in fact it's a virtual world, and in reality everyone's plugged into a machine and keeping the machine going. And that's a little bit, again, there's no criticism of the finance industry, but it would be the same across any industry. People are asked to believe something as part of a sales thing, and that this world is the real world, when the reality is this other world's going on. So part of the, and this is a criticism of sorts, is that the advice world doesn't want to be disturbed by clients. The game is to get a client on board, keep them on board. And in a lot of advice industries, the best thing to do is to tell the client that they don't have to do anything. It's all long term. Buy and hold. It's time in the market, not timing the market. Last thing they want is a client ringing up every 2 days saying, do I sell BHP now? Do I buy BHP now? So inactivity is the matrix. Want clients to be inactive so that they get the same amount of fees with very little activity. At the same time, again, no disrespect, but the strategist economists of most major institutions are there to pacify the client base. So if a major economist was to say the market's a sell, they would get 250 phone calls from every advisor in their bank or in their funds management group saying, what on earth are you doing? I've just sold someone a product which is obviously optimistic about the market going up, and you're saying sell the market. It would just be havoc. So you have to understand that most strategist economists are there to tell everybody everything's going to be okay. And it starts right with the RBA. The RBA is there to keep everybody calm. And they're the first finger waggers, and then the finger waggers come down until you get a broker on the desk who's not a finger wagger, who wants activity and trying to trade. So at some level of the industry, there is a push to keep everybody happy so they don't ring up in a panic. And that way the industry can make money without activity, because if a client rings up and says, do I sell BHP? 20 minutes on the phone, no extra fees, it's a nightmare. So the matrix is the idea that you should be happy in the long term, buy and hold, time in the market rather than timing the market. And if anyone ever says, this was a good one. I once wrote an article on a Saturday in The Age which said, if anyone, in the middle of the GFC, if anyone rings you up and says, if you never sell, you'll never take a loss, he's an idiot. And the next morning, this big salesman came piling down the dealing room, and the broker I was working at going, what did you write in the newsletter? Because he'd sent an email that Friday to all his clients saying, don't worry, if you never sell, you'll never take a loss. So if anyone does that, change your advisor, right? But that's all part of the same construct, which is keep everybody happy. And usually it's right, keep everyone happy. But you have to ask, should we have done something in the GFC rather than keep everybody happy? Yeah. And yes, we should have done.
Okay. I've picked out a couple of the popular sayings that you called out, and I thought we could maybe just go through them. A couple of them, I would say there's a grain of truth in them, or some solid evidence of truth behind them. So the market always goes up. Now, in the short term, no, but history has proven that stock markets do rise over time. So what's your take on that one?
You can do better. People are, if you were to rely on that, you lost, was it 11 years from the GFC to recover the highs? So it depends what time period you're in. If you catch the wrong 10 years, you catch the wrong, you're done.
Yeah.
If you happen to have retired in the US in 2000 at the top of the tech boom, you were destroyed. So you have to time the market. Yes, the market generally always goes up, but within that, you have to protect yourself from precipitous moments. And our brief in our mandate to ourselves is participate in bull markets, avoid precipitous moments, and we do that.
And we all don't have a 130-year investment time frame.
Absolutely not. No, and if you look at it's not so much about protecting yourself from loss. It's the opportunity, because if you can catch the bottom of a market, catch the top, catch the bottom, the accelerated gains in a short period of time always come at the bottom of the market. We celebrate the tariff tension, the GFC, the pandemic, the taper tantrum, because it's opportunity. As Henry will tell you about the fund we run, we need big pivot points in the market, and because they're tremendous opportunities. You look what's happened in just the last couple of months. The recovery in the US markets is a tremendous opportunity, but you can't take advantage of it if you've sat there the whole way through.
Rode out all the way through. The other one, invest for the long term. That seems like a sensible strategy to me, but you've called that out as one of the market sayings that you have a bit of a beef with.
Because that's part of the matrix.
Yep.
And also because, again, we're here to exploit opportunities in any price over any time period, and just to say everything's long term is go and ask anyone at Babcock Brown what they think about that, and other companies that have gone bust. You can't just be long term. That's a brainwash.
Yeah. Now, you've been talking a bit about this market timing and your market timing strategy. I think you may have historically been in stockbroking, used shares as your go-to investment vehicle for implementing strategies. Tell me a bit about how you've reinvented the way that you like to implement your ideas.
Okay, so our managed strategy portfolio, which is the real fund we run, only uses Australian listed ETFs. Simple box for us to look, set universe, everyone understands them. Maybe they don't, but if you look at, say, look at United Health. As I sit here today, I think it's up 14% in 2 days. It's a $286 billion company in the US. It's in the Dow Jones Index. There are only 30 stocks chosen to go in the Dow Jones Index. Rubbish index, but still. Only 30 stocks. United Health has, since April 14th or so, last 5 days has fallen 29%, gone up 14%. This is the most unattractive part of individual stock investing, is now, presumably because there are a lot of computers involved, is this announcement risk, individual stock volatility. It's a shocker. And investing in ETFs, which by definition are grouping a bunch of stocks together, we focus on passive ETFs, so we haven't got a fund manager involved in the middle going, I think it's clever to do this, clever to do that. So it would be over an index or a sector, or the most obvious one is MVB, for instance, which is every Australian bank, the 4 major banks. You are avoiding the individual stock volatility. I think every stock should come with a volatility measure. We do it in the newsletter. You can just simply look at average true range as a percentage of current share price, and you'll see Telstra is less volatile than the ASX 200 index. It's astonishing. And you list them like that, and if you look in the top 20, all the major banks are in there. Is it any wonder all the conservative, I don't want to be kept awake at night investors hold all the banks? Because by nature, they've worked out they don't keep them awake at night. So everybody needs to have a volatility awareness, and people will talk about mineral resources in the same breath they're talking about the CBA, but mineral resources is moving 10% a week. And so everybody needs to be volatility aware, and the most marvelous, and the reason CBA share price up so much last year is because it's the safest stock. Everyone understands it's safe. ETFs are safer. And it takes a lot of the volatility away. It takes the announcement risk away. And it also, one of my little bugbears is it takes the fundamental analysis of individual stocks, which is almost always highly flawed, away as well. So once you group all the stocks together, you're playing a theme. So we can play the market theme, we can play sector themes, and that's a very attractive piece of analysis to do. What are all the oil stocks doing? What are all the big tech stocks doing? As opposed to having to look into the guts of United Health to see whether you're about to have a shocking announcement.
Yep. And tell me about the market timing component. How does it work? What do you look for? What are the catalysts that inform your decisions to, go to cash as you did in early April and then to go back into the market? Because there is lots of research saying that it's not possible to time markets, and shortly after a big down day, there's often a big up day as well. So just tell me a little bit about how you go about market timing.
Everything is a balance of fundamentals and sentiment. So in market timing, we're playing with sentiment. So everybody knew at the end of last year, after a 38% run in the NASDAQ, that big tech was getting overvalued. The average PE was 33, 34. That's excluding Tesla, which had 100. And everyone knew it was overvalued. So you're looking for the moment that changes, because it's very hard to see it just keep going forever. There's a moment coming. So the best opportunities are when finding stocks in bubbles and stocks in holes. So that's what timing the market is. Market in a bubble, market in a hole. Particularly if you're in ETFs. Last year we were in all US related big tech type ETFs, massively outperformed the Australian market, which was, apart from banks, was going nowhere. It was so easy last year. Australian investors had to get out of Australia last year, another reason to buy ETFs. So that you're dealing with sentiment, not fundamentals. You never time the market. You'll never time the market on fundamentals. You'll see a series of things happen. At the top of every market, bottom of every market will have different ingredients depending on what the market's obsessing over, and you look for the turns in those. So I can't tell you exactly what the current I can tell you what the current ones are, but the next pivot point is going to have different ingredients because we're going to be obsessing over something else. Yeah. The other thing that happens is that big moves mark tops and mark bottoms, start trends. Yeah. So we have this, we're looking for a big drop or a big rise. When we saw that 12% rise, we bought the market the next day when we in the bottom of the tariff tension. We cashed out completely after, on December the 18th, after a 3.5% fall in the NASDAQ in one night. We hadn't seen that in 18 months. And that was, okay, there's a very good chance it started. You can never know for sure, and we have cashed out a number of times and got it wrong, had to get back in. But it doesn't do us any damage. If you cash out, you've got no risk. So we cashed out. The market was obviously in a bubble, big tech in a bubble. We cashed out after a big drop, and wow, look back now, that was the top of the market. As it was, we got back in January, had to get out again. But the way you do that is to watch sentiment changing. And you can only do that, and this is our risk management. We are hyper vigilant. Every day we're all over it. We can't sit back and let it go, and we're all over it every day. We have this rule of reacting, not predicting, and making decisions every day based on fact, not based on fantasy. So anybody who listens or thinks about someone saying this is going to happen is missing it. You wait for it to happen. Once it starts happening, you have to be decisive. We're decisive. We're decisive for people. One of the worst things for most self-directed investors is they can't make a decision. So we do that for them, and it's been working. Yeah. So we've done this since 2018. We've had almost a 20%. It's 90. We're just trying to get it to 20% per annum. It's 19 point something at the moment. We're just trying to get 20%, but this works. And we timed the pandemic. You ask any of our members, we timed the pandemic perfectly. We timed the bottom of the market in November 2003 when the Fed had a meeting and the market took off because they declared the inflation problem over. That was the catalyst. One big day, in we went and ran that for 18 months till the top, and then this taper tantrum. So it's working. and we'll just keep pursuing that for all the criticism and other, and it's not conventional, but it's working, and we will see what happens by the end of this year. It's going to be a very interesting year to see if we can do it again, keep doing it.
Yeah. And so where are you positioned now? How are you positioned? You were out of the market in early April. You're back in on US tech. Tell us about...
James, I don't want to make this chat topical, because things will change. Yeah. So at the moment, we've spotted the change in sentiment towards tariffs. It was obvious. Trump blinked over the bond market, and we've been in a very sharp recovery rally. Endless days going higher. A great recovery, almost to our highs. We're 3% of the highs now. So we played the recovery rally. We bought ETFs that would recover. So big tech, small companies, these are US ones, and FANG, U100, and wire, copper. If you looked at the copper price on the day of Liberation Day when tariffs were 29% average instead of 10%, copper went bang. And that was obviously going to come back. So we're playing the wire ETF. Ask me in a week's time. It'll probably be different, but I think it's going to mature a bit. Hopefully we'll settle into a nice bull market. We can play market ETFs for the rest of the year and sleep at night and get our golf handicaps down, but I doubt that's going to happen. And
noticeably absent is any exposure to Australia. Why?
At the moment, resources we haven't held resources stocks since the beginning of last year. I know there's been a load of volatility and opportunity, but the macro backdrop compared to the macro backdrop for big tech, macro backdrop is China, weakening economy, and then the tariff tensions, and there's been a market sympathetic rally at the bottom here in resources, but the big trend is against commodity prices. The other thing that's happened is the US dollar's dropped 11% this year, which is good for commodity prices. And I reckon now the trade tensions coming out is going to recover that, so that works against commodity prices. So until China actually does something stimulates meaningfully, the resources sector is of no interest because it's a big theme. Okay, you can go and look at BHP, go and work out the return on equity of their Brazilian subsidiaries, completely irrelevant. Commodity prices have to go up, iron ore price, coal price. So resources have no interest at the moment. There's a great trade coming. Everyone's going to jump on it, but resources have been of no interest to the rest of the world since the resources boom in 2000, 2008. And if you went into New York in 2008, every Wall Street banker would have known who Twiggy Forrest was. Ask them now, they wouldn't have a clue. So there are no interest. So that's when Australia comes alive. So that's why that's of no interest. Otherwise, you've got the banks, most fabulous income stocks in the world. Don't grow. Look at the last results season, -3% earnings, plus 1%. They are the safest. They're too big to fail. They're ploughing cash out of us. They've got no competition. They're paying huge yields because they've got no options for growth. And let's hope they keep it that way. Brilliant income stocks, but that's not going to make us money, especially not now they've had their rebound. So there's 50% of the Australian market, and the others, REITs, we're not going to impress people buying REITs, utilities, infrastructure stocks, and then some industrials. And you look at our tech sector, 3-4% of the market, the most appallingly constructed index you could imagine, putting computer share in our tech index, for goodness sake, because it's got computer in the name, and it dominates it. But that sector is following sentiment around a big tech. So they're all in our growth portfolio, which is a separate portfolio. But we're a backwater economy, 26 million people, and we've got no AI. So what's our theme? There isn't one at the moment, so not interested.
There's a big US position that you've been playing out. Now I know things can change, but just for the time being, what's the bull case on the big US position? Because a lot of people we've read about in the papers, super funds positioning away from the US, talking about the end of US exceptionalism. We had the DeepSeek, announcement earlier this year, which put some threat or some question marks over the future of the AI profitability for the US businesses. What's the bull thesis on the US for you?
Name me other growth themes in the world. We're in an industrial revolution with AI. There will be other themes, I'm sure, in the future. And AI, I'm sure, as a theme will one day wake up to, we've spent too much money, there aren't enough earnings. But at this point, they got absolutely hammered. NASDAQ down 28 point, whatever it was, 35% or something in the sell down. That's a sentiment thing. And we've seen the sentiment rebound. So that's why we're in it, for this recovery phase. But I think also there is a good chance that money will continue to stick in the sector because it is such a fabulous long-term unknown theme and we're all using it. Can't remember the last time I looked up Google. It's always ChatGPT now. It's huge. And it's changing the world, and people are still interested, excited. So growth theme. It's not based on fundamentals, although it might surprise you how not expensive some of the big stocks are. If you told me I had to put all my money in one stock, it would probably be Microsoft. Because it's got us all. Yeah. And anything that is a good idea, they'll buy it. Anything that competes, they'll buy it. That we're in a new world in our lifetime, James, where I remember when I first started broking, the senior partner had to pick up the phone to the US to make a really important, expensive, long-distance phone call to find out what happened in the US market. And here we are with companies that can access the world's billions of people with one thing on the internet, and that is still happening, and those guys are going to get bigger and bigger. So I still think that's a growth theme. It's not very scientific, but you tell me what other themes there are running, and we'll have a look at them. But it's not resources, it's not Australian banks, they're not growth themes, and there will be others in the ETF space. Defense is another one. Cyber security is another one. There are all sorts of others to play, but essentially, as the biggest themes, the US market is still going to outstrip Australia in spades if the bull market remains.
Stays intact. Marcus, one of the things a lot of our audience are interested in when they hear an investor or fund manager talk is the strategy you talk. Is it, do you eat your own cooking, and is this how you invest your own money as well as the portfolio that we've talked about?
Well, this might sound silly, James, but I was looking at how do I step back. I play golf. I like golf. Our kids are out of the house. Maybe I should step back. And now I've gone and started a fund because I can see what would happen if say I retired. I'm too young to retire. But if I was to retire, I'd probably say, thanks very much, subscribers, I'll finish the newsletter. And then I'd sit at my desk and I'd start looking after my own super. And I'd probably get some friends to talk to about it. I'd probably send them an email in the morning, and I'm not sure what the subject line would be, probably Marcus today. So
You'd be doing it anyway.
I might as well keep going. And yes, my super's in my fund, and it's my mission. And then the way I see it is, well, everyone's along for the ride. Don't criticize me. Don't be nasty about what I'm doing. You're either coming along and accepting it or not, because my purpose is entirely to succeed looking after my own money. And one of the things I feel like every direct investor that the finance industry doesn't realize they feel is, God, I don't want to lose any money. And God, I want to get out when the market goes down. I don't want anything to keep me awake at night. So yes, so this is my purpose, this managed strategy portfolio. My money's in there. I invite anyone else to come along. James, you should be in there as well. And you can ring me up and say, Marcus, you shouldn't be buying that one. I'll listen.
I run my own money. I look in the mirror and I can give myself a good talking to if I'm unhappy with my performance as well. But people may want to find out more about what you're doing, follow along the journey. As I told you before we shot, YouTube channel's got some great videos. Where do they follow along the Marcus journey?
Well, this is a bit of a con and a plug, but if you actually open an account on the Open Invest website, platform, which runs our fund, you can sign up without putting any money in.
Oh, there you go.
And we're reinventing the way reports are done. So most fund managers are doing a monthly report. Why are they stuck in that? Is it a compliance box of this is how it's done once a month? We'll produce numbers. Please don't email us and explain what they're doing. You know, they would switch some CBA into NAB. Oh, goodness sake! So we're writing what we're doing as we're doing it on the platform. And Open Invest, Andrew Varlamos, who has run that business now for 7 years, his driver was probably similar to yours and mine, was to provide a platform where fund managers could communicate. So we're going to use that platform and communicate with people, not just fob them off with a monthly report. It's all up there on your own portal, and if you really want to, you can abuse us by opening an account and not putting any money in.
Oh, well, let's keep
but the hope is you'll watch it and go, oh, I better put some money in.
Very good. Well, Marcus, thanks very much for coming in and having a chat. Appreciate you making the trip to Sydney, and always good to get some of your views and hear what you're up to.
It's really good. Thanks, James.
Ladies and gentlemen, I hope you enjoyed that interview with Marcus. Stick around because we're going to be putting up another video in just a day or so where I've got a bunch of questions that our readers have sent in, and I'm going to get Marcus to go through them one by one and see if he can give us some spin on those. Subscribe to the YouTube channel. Make sure you stay up to date with what we're doing.